For more on the market action and reaction to the jobs report, let's bring in Dan Deming at KKM Financial. Dan, the market is less volatile. What are some of the signs that you are watching?
Well, you're right, Angie, especially when you look at short-dated realized volatility, which basically is a measure of what the market's moved, let's say, in the last 10 trading days. We are seeing that ticking lower week over week, and we did see it tick lower by 4 points last week. So there's no question from a short-dated standpoint, we are seeing less volatile moves in the market. Overall, though, there's still some elevated concerns out there, and we did see some late selling, last week, particularly on the end of the month, that I think the market's going to have to contend with as we move through this week. And also, we have several data points highlighted by the Fed minutes this week that I think are also going to influence the markets.
Now that the jobs report is out, what are you watching as far as economic news this week that could motivate the Fed?
Well, anything inflation-oriented, because the jobs number was pretty much in line with expectations, and we did get even a higher revision in the previous month. So, the Fed feels very good about the employment front. So they're going to really focus, I think, on the inflation front. So any inflation data this week. We do have a few data points, nothing too significant really as far as market movers probably, but the big market mover could be the Fed minutes that come out in the middle of the week, Angie. That's something that I'm going to keep a close eye on. And we will be getting Fed speak throughout this week as well. And the markets will be listening very closely as to how they may move in the coming meetings, particularly now with the expectation of a 50 basis point increase in May.
Overall, how are traders reading the jobs report?
Well, traders are reading it. I think overall it's good, but I think the bigger factor for traders right now is keeping an eye on the Treasury markets and the inversion of these yield curves in the middle of the duration. So basically, as it creeps closer and closer towards like the 2-year, 10-year now, which is inverted. And what that really means, or it signals, is that at some point here in the next coming couple of years, that the market's anticipating a slowdown from an economic standpoint. And if that continues to move into like a 1-year cycle or even a 3-month cycle, which a lot of market participants get very nervous about, that's something that I'm keeping a close eye on, because we are seeing that inversion in the yield curve creeping closer and closer to shorter dated durations.
Thank you, Dan. Have a great trading week ahead.
All right. Thanks, Angie. Thanks for having me.
Go to businessfirstam.com for where to see our show on TV.